Oh, looks like I was able to save 50 bucks this month. What can I do with this money so that it can earn me a great return without unnecessary risk? Oh, hey there, my friend. Are you asking yourself the same question? Yes, how can you invest the money that you're able to save every single month and earn guaranteed returns without, and I'm talking about nice, decent returns without the unnecessary risk that you get from the stock market? And that's exactly what we're gonna talk about in this exciting episode today, okay? How you can invest, even you as a beginner, in every single month and get guaranteed returns on your money, okay? Without taking excessive risks in the stock market. I'm going to show you and talk to you why the stock market is probably not the best place to go in. In fact, I'll show you why many of the rich people are not and what they're doing instead. Because instead of risking their money in high risk assets like stock markets and bond market right now, they're actually investing it in very little known strategies that, yes, even you can take advantage of. They seem a little bit new in the beginning, but trust me, I will walk you through everything. Most people are not talking about this. Most people have no clue about this, but I'm telling you, this could potentially change your life, set you up your retirement up much nicer than you ever thought imaginable, and give you a lot of flexibility in between without all the worry about, is my money going down every single second when the stock market is doing all these gyrations and up and down? You won't have to worry about that. Before we get started, hey, my name is Chris. You know me, all about making money, investing money so you can get outcomes and results in your life that matter to you. All right, so if you like that, hey, definitely give the video a like, consider subscribing to the channel, and go ahead and smash that bell too, because that'll let you know whenever I'm dropping new videos, which is pretty much regular. All right, let's get to this, my friend. So there's a few things to remember, okay, that I like to talk about. First of all, I recently have discovered, and not that I discovered it, but I recently discovered the fact that I wanted to share this more with you guys, because we've been talking about making money, which is good. I like making money, but hey, that's not the only thing, right? You got to learn how to invest that money too, because if you're working all your life trying to make money, then you'll be working all your life to make money, because you'll always need money. But if you can learn how to, number one, create systems to make the money for you, you're winning. And then number two, how to take that money to work for you to make more money, well, now you're winning. And that, my friend, is the key to financial freedom, economic independence. And the key to all of that, my friend, is really education, okay? It's one of those things they don't tell you, but you're not gonna learn all this stuff overnight. It's something that you have to, over time, constantly be educating yourself on and reading on. And I think you just have to have like a little bit of interest in it. If you don't, find somebody who does, who can keep you abreast of what's happening. But you got to know some of the basics, okay? So that's what we're going to talk about. First thing that I want to emphasize to you is that regardless of what everybody's telling you right now, the stock market sucks right now. It absolutely does. I've talked about this in another previous video, and it's very simple, all right? It's not because I'm just saying it. There's very simple metrics you can use, right? That's why I'm a healthcare professional, and we don't diagnose patients just because, oh, you're sick. No, we know there's a very specific reasons why you're sick, because there's key metrics and measures and parameters that we're looking at, lab values that we're looking at that say, hey, there's something wrong here. We need to be very careful with you. Same thing with the stock market. I'm diagnosing the stock market right now, and I'm not liking what I'm seeing. Why? First of all, there's a ratio that's called the Buffett indicator, okay? Warren Buffett, I guess he was known to have kind of coined it, but basically what it is a market cap to GDP ratio. What it is it takes the overall amount of the market, the total value of the stock market, and divides it by the GDP, which is, you can just think of that as the income that the country brings in, what we produce. So the value of the stock market divided by what you actually make, right? If you go to this website here, there's a website I found, it's called gurufocus.com. Basically, it talks about it, right? And it's showing you right now that based on historical trends, that the stock market is significantly overvalued according to this indicator. Why? Because the historical ratio of the target market cap over the GDP is likely to return. According to right now, it is at 183.7%. The market cap to GDP is 183. It's likely, because of that, it's likely to return you. If you were to invest money, you're $50 in the stock market right now, in the next year, you're going to earn negative 2.3%. You're going to lose 2.3% every single year, and that is including dividends. I don't know if anybody's telling you that, but that kind of sucks. Who wants to lose money? Especially if you're getting older, you need your money to like live. You don't got time to be taking unnecessary risks like this.
Pardon the interruption, my friend, but hey, are you enjoying this video so far? Getting value? Then hey, go ahead and like this video and subscribe to the channel, all right? And go ahead and tell me where you're coming from, all right? Where in the world are you from? Where you're trying to learn how to make this money, all right? So if you're enjoying this video, go ahead and give it a like and subscribe. All right, now back to our regularly scheduled programming.
And just to put it in perspective, typical ratios for fair value for the Buffett ratio would be anything between 94 and 115. We are currently sitting at 183.7. Probably, I think I've read higher than it's ever been historically in recorded numbers. Okay. What about the fact that there's insider selling happening right now and it's the CEO sentiment? So I pulled up this article here called Fortune.com where it's talking about when it comes to the optimism divide between CEOs and investors, somebody is wrong. Basically, in the article, they're talking about, hey, there's something going on here because American CEOs, these are the people who run businesses and companies and they see the landscape of what's happening in our economy, are not liking what they're seeing. They're very unhappy and very fearful, while regular investors like you and I and people who are investing in the money seem to be very bullish and running in full strength. That's not good, okay? Because I mean, I'm good at what I do, but I don't have the viewpoint of a CEO who runs a business and can see the economy and see everything, the landscape, right? So they are scared. I should probably be scared too. Another article in CNBC here talking about CEO confidence in the economy has cratered while consumers believe that everything is okay. And this article was written in January of 2020, so it's about a year old, but it hasn't changed. In fact, it's gotten worse. Saying consumer confidence is heading in the opposite direction from the sentiment of corporate boardrooms. That doesn't make sense, right? Consumers are optimistic, but CEOs and CFOs are downbeat, fearing at least a downturn, if not a recession in 2020, which is interesting because we did see a downturn, but then we have this massive recovery coming now into 2021, but people are still scared. In fact, there's another article here on CNBC. This is just recent. As I'm doing this video, January 4th of 2021, Carl Icahn, one of the most well-known investors, warns that the market rally could end in a painful correction and is hedging accordingly. This billionaire is saying, hey, I don't like what I'm seeing. I'm going to protect myself and hedge my bets right now. In other words, just protect himself so that if something does happen, he still gets paid and he loses very little money. What are you doing to hedge your investments that you have in your 401ks, in the stock market, in your ETFs? And then there's something I always love. I listen very little to the words that people are saying, and I pay attention to the actions that they are doing. And nothing screams action and fear than insiders actually cashing out their money, okay? And that's what this one article here that on one of my favorite websites I like to go to is called Real Investment Advice. It's talking about. He's like, hey, look at the fact that right now, ETFs is a booming business. Wall Street is like just creating all these ETFs because all the retail investors, you and I, the people at home, want to get into all these ETFs. The ETF fund is going at an all-time high. As you can see here, they call us dumb money, by the way, and that index is going higher and higher. All the while, you see insider transactions ratio has been peaking. I mean, they're selling like crazy right now. Selling. We're buying and they're selling. And these are the insiders that know what's going on. They got the inside scoop. Anyway, as a result, I conclude that the stock market is not healthy right now based on all the data that I've kind of shared with you. And there's a ton more. We just kind of scratched the surface. So I don't believe that's the best place to put your money. In fact, it just screams to me as a place where you're taking unnecessary risk. Yes, the stock market could go up. Someone may tell you that the Fed is going to continue creating currency, QE and all that. But still, though, it's still extremely risky. Why take that risk? I don't like it. And in fact, there's other concerns too. We got to take in fact inflation that could potentially may or may not happen. There's this huge debate between deflation and inflation. The taxes, you're paying unnecessary taxes on your earnings, fees that you may be paying on different ETFs and funds that you have, and low interest rate environment, right? With low interest rates being in the toilet, almost near zero, bonds are paying nothing. How then can you earn enough money and grow your money safely, securely, and actually earn some interest on it without taking unnecessary risk in the stock market and avoiding inflation so that it's growing so it beats inflation without having to pay taxes and fees? The answer, my friend, is a method called cash flow banking, okay? I've talked about it in a few other videos and you may or may have heard it, and it works with whole life insurance. This is what, my friend, what they call the rich man's Roth account, okay? The Vanderbilts, the Rockefellers, the richest families in America apparently were using these jokers, okay? It's good enough for them. I don't know. It may be good enough for me. It ain't good enough for you. How now? But how does it work? Okay, here's how a good way to think about it. And once again, I'm not a pro. I'm just sharing with you some information that I think is going to be extremely valuable to you, that I think everybody needs to know. It changed my life when I first learned about it. I've taken action on it, and I've thought to myself, holy moly, people need to know more about this, okay? So here's how it works. It's a life insurance policy, whole life insurance. Yeah, I know. You've heard from Susie Orman and all of them that it's no bueno. That's what I thought too, except think about this. Okay, in a life insurance policy, generally this is you and you're buying policy to insure a loved one, okay? And maybe that policy is $200,000. So in the event that this loved one dies and their income goes away, you will be paid out from the insurance company $200,000 in death benefit that allows you to take care of all the financial obligations so that person had, so you can move on, burial and all that type of stuff. So that's a regular policy. Now, what if I told you could change up that policy a little bit? In fact, instead of just it being a $200,000 death benefit, there's actually a quirk in the thing. A quirk, that's crazy, right? Where inside the policy, there's a portion of the death benefit that's called cash value. In other words, it's just like cash money, where you can put money in there. Let's say you had $50. You could put $50 and deposit it every single month into this policy as if it were a savings account, and it will stay in there and continue to grow the value of the cash value along with the death benefit. So what happens is that over time, all your death benefit could have mounted to over, let's say, 10 years, compounded to $10,000. And then your death benefit would have increased to, like, let's say $400,000, okay? That's the crazy thing about a whole life policy, is that eventually it increases in value and continues to increase in value as long as you're contributing whatever amount that you said you were going to give, like in this case, $50 a month. And that could compound into a nice little bit of cash inside the policy. Now, here's where it gets kind of interesting, okay? As this is happening and you're putting in $50, your death benefit has gone from $200,000 to like $400,000. So when your loved one dies, $400,000 is given to you as a death benefit, but in the meantime, it would have increased into, like, let's say $10,000 of cash value. What is this? What is happening here? Number one, this whole life policy gives you like guaranteed returns. Now I said 5%, but I think it ranges between like 4 to 5% or whatever the case may be. But that's guaranteed returns. I want to emphasize the word guaranteed, okay? Guaranteed. That's crazy, right? The insurance company will guarantee you 5% returns on your money, on this death benefit, on this cash value every single year, provided that you continue to contribute, right? That's crazy. I don't know where you can find guaranteed 5%. Like we said, the stock market is not guaranteed. Super volatile, super risky right now. Bonds, please, it's less than 1%, 0.9% at the time of this video, right? So you can't get that anywhere. Real estate, overvalued right now, very risky. 401ks, mutual funds, ETFs, please don't get me started with that joker. And by the way, you should see my video on why 401ks suck, okay? But no, there's no way to get that. 5% is huge, guaranteed. That is huge. On top of that, you get dividends, okay, from the company, because the way these companies, insurance companies work, you get profit sharing. So it's just like being part of a different owning a share of the stock. You get paid out dividends based from their profits. It can range between 1 to 3%. So I say, hey, just give it a straight 5%, okay? It can be more. I'm just calling it straight 5% total returns. That's really, really nice. On top of it, tax advantages. So your money grows tax-free when you put in. When you withdraw your premiums, you don't pay any taxes on it. The returns, you do pay taxes on. But hey, that's so far down the thing that it has time to continue growing and you don't have to pay any taxes on it. It's crazy. On top of it, it's a credit line. Here's one of the things that I think is extremely beneficial. This thing allows you to be your own bank. Maybe you've heard that before. So it's called cash flow banking or infinite banking. And the whole idea is that you are able to leverage your money. The money that you put in here, this $10,000 of cash value is in there and it's continuously growing and compounding at 5%. Guess what? You can actually take a loan from this money. The insurance company will give you a loan of $10,000, bam, in your hands, quick. Fast cash in your hands that you can use to do whatever you want to do with, right? And the beauty about it is that 10,000 is a loan, so you don't have to pay any taxes on it. And your original 10,000 that's in your policy continues to grow uninterrupted at 5% compounding. That's disgusting, right? Because it's continuously growing. All the while you took your 10,000 loan and you used that to do something else, invest in something else, pay off some high interest debt. For example, if you take out the loan, it'll probably cost you like, let's say 5% interest, right? It's not free. The insurance company's got to get some money. No problem. You take that 10,000, it's costing you 5%, but guess what? You have a credit card that's got like maybe $8,000 on it. That's costing you 20% interest rate. Oh my God. You just recovered almost, let's say, 15% in interest. You see what I'm saying? Because you take 5% money that's costing you 5% and used it to pay off debt that's costing you 20%. You just recovered 15% interest. That's called being your own bank, okay? Recovering the interest differences that's been costing you money. Let's go. On top of it, there's all kinds of benefits like in terms of protection, right? So you're protected from bankruptcy, from creditors trying to get at your money. It's private, so they can't see it. It's these slimy lawyers and people who want to litigate against you, sue you, they can't find it. You're protected. And of course, it's an insurance benefit too. So it pays out $400,000 or whatever amount it is as it keeps on going higher and higher every single year. Let's go. As you can see, I'm extremely excited about it because it's insane to me that something like this exists and nobody has told me about it. Nobody's telling anybody about it. It's insane, okay? And so I really, really want you to check this out. But be careful, my friend, because not any insurance company will work and do this, okay? Not any one. You need to find a special kind of insurance company that does this. Usually they're called like mutual insurance companies. And generally there's like a few criteria that I've seen. My boy Garrett Gunderson, he talks about this, that you got to take a look at. They got to be around for about 100 years, consistently have been around, paying out, and there's a lot of stuff. So don't go to State Farm or Progressive. All these ones that you see on TV, they're not the ones you want to go to. You need to go to a special type of insurance company with a special type of insurance agent that actually knows how to take these policies and work them around. It's kind of like going to the doctor's office. If you go to the doctor's office and you talk to your doctor there about, hey, I need surgery. Everybody, for whatever reason, thinks that every doctor is a doctor and they know everything. No, they're not. There's like different kinds of doctors. You don't want to go, if you go to a surgery doctor, he's going to know about surgery. If you go to a kidney doctor, they know about kidneys and dialysis. They don't know nothing about surgery. So just because he's a doctor doesn't mean you should go there to him to get advice about how to do surgery and have him do your procedure. That would be silly, okay? If you talk to that surgeon, he ain't gonna know nothing about kidneys, or dialysis. They get some training in medical school, but it's not something that they do. You see what I'm saying? You want to go to somebody who specializes. Like, this is what they do. They do surgery, period. Same thing with insurance. You want to go to an insurance company and an agent that knows exactly how to set this up. They don't mess you up. They set up the policy the right way, because trust me, if they don't, it can actually cause you more problems than if you have never done anything in the first place. So that's it, my friend. If you want to check it out and you want to learn more about how to do it, I have a link in the description below, and this page will take you to this page where you can get more information on that, okay? I think it's one of those things, once again, you just got to get educated. It may or may not be for everybody, right? Not everybody can probably do it, but I think it's something that everybody should definitely consider. And low key though, I think everybody should have something like that, right? When I've looked at it, it looks, I got several policies myself. I got my brother getting his policy. I got my fam doing it. I think it's something that everybody should check out. And why may take unnecessary risks in the stock market when you don't have to, right? And when there's other more secure, safer, secure ways for you to put your hard-earned money so that you protect yourself against inflation, protect yourself against from interest, unnecessary interest rates and taxes, and start to grow your money safely, build your wealth safely so that you can be independent, financially free, economic independent, free from all worries. Let's go, okay? So anyway, if you want to check that out, there's a link in in the description below. If you got value and this was helpful, hey, definitely give the video a like and subscribe to the channel. Check out some of these other videos on this channel on how to make money or invest it, okay? And so until the next exciting episode, my friend, you be blessed, stay hungry. I'll see you on the next one. Peace out.